Well, hello, this is Anthony Parent of IRS Medic, and today we're going to be talking about an interesting topic with my guest, John Richardson and Keith Redmond. We're going to talk about instances where there's not income, but there is an income tax. And first, and this is one thing that a powerful word that our government uses all the time, and it's a dangerous word. I want to show you what this word is. I'm going to share my screen. This is the word that's so deemed dangerous. It's deem, DEEM. And this is what it means. It means to form or have an opinion, judge, think. And we're going to see how important this word is, but we need to understand what this word is as we're going through here so we can kind of see what our government is doing. So John published a fantastic article, and he went over some great examples of when the U.S. creates unrealized foreign income before a realization event occurs. And so something I want to ask for everyone on this podcast watching us is if they could think of other instances of where the U.S. creates unrealized foreign income, or actually any unrealized income, not just foreign. I'd also like to know some examples of that. So if you want to chime in with some ideas of what you have. So John, thank you so much for this article. So now where do you want to start, John? Do you want to start with 965, the transition tax, or do you want to start with some other lovely things we have here on your list?
Well, I think what I'd like to do before we get to the things on the list is actually start with a problem here. Okay. The problem here far exceeds what the litigants and more imagine it to be, or at least are concentrating on. And basically, we've talked and we'll continue to talk about the Moore case, I'm sure, until it's heard, and probably well after it's heard. But what the Moore case is about, as listeners will know, is the U.S. attributing the earnings of 30 years of a foreign corporation that's not owned by the individual to that individual. So they retroactively attribute 30 years of somebody else's earnings to the U.S. citizen, and then say, that's how they say, let there be income. And then by attributing to them, they say, poof, and yes, there was income, which they've never received, but they're going to impose a full present day tax on that. Now, this is the basic problem, and it's extremely abusive for residents of the United States. For example, let's just say that the government decides to go after 401ks, which they surely will, incidentally. There's no question where the trend is going here. And they say, well, you know what? That 401k you've got, we notice that's increased in value. We know that you haven't taken any of it because you want to continue to let it grow. But you know what? We're not bothered by the fact that you haven't actually received any. We're just going to say, you know what? We're going to pretend, we're going to deem you to have received the income on the increase in the value. And this is, they're going to go after resident Americans. Okay, I have no doubt about it. They already are in certain ways. For example, the forced distribution of the Roth IRA, et cetera, that we've talked about over the 10-year period in the Secure Act. But where this is where the problem takes on a completely new dimension is where you have U.S. citizens living outside the United States in a world of citizenship taxation and FATCA. So let's imagine, for example, that a U.S. citizen living in, say Canada, because I'm looking out my window, but you can substitute your country for Canada. Pause, do it right now. Let's imagine that you had a stock portfolio, no U.S. stocks, by the way, at all, not a single one. You have a stock portfolio of non-U.S. stocks, and let's say that had gone up in value, had it for 10 years, started at $1,000, now it's worth $2,000. Now, of course, what you're doing is you're probably not selling because if you sell, you pay a tax and there's less to grow in the investment. So you don't sell, you keep it as your retirement plan, so to speak. And I will never sell that until I retire because I don't want to pay tax along the way because I'll have less to invest. And now the Americans come in. with a deemed realization event. They say, buddy, you are a U.S. citizen, and for that reason and that reason alone, we don't care where you live. We noticed that that has increased from 1,000 to 2,000. So we're just going to pretend that, we're going to tax you on the increase right now, 1,000, and we're going to call it income under the Internal Revenue Code. All right. And so you're going to have to pay that to us now. Now, the first thing that happens is that erodes the amount that you have to invest. Think of all the people who were forced to liquidate their companies under the transition tax. But the second thing it does, and this is the genius of it for a government that hates its citizens as much as the United States clearly does, or at least its citizens abroad, is that all of them? Okay. All right.
Yeah.
So what we have is a situation where first the U.S. taxes it. Okay. Now Canada, now it's not taxed in Canada until years down the road, and of course they don't pay attention to the U.S. tax; they'll just tax the distributions. But the point here is that because there's a mismatch in the timing, there's no possibility of using any foreign tax credits one way or the other.
Yeah.
With me on that? So
yeah, exactly. That's a huge problem. So that you miss out on the taxes that you paid to foreign, and you don't get credit for that. So you are double taxed.
Well,
or
of
something
course,
that's not even.
That's not even the biggest part of the problem. The problem is they're eroding your investment capital as well. And for any Canadians listening to this, why don't we put this in the context of a TFSA, right? That's not taxed in Canada, or an RRSP that will be taxed in Canada. Any of these kinds of things. Now, final thing I want to say before we get into the examples is that this is a problem that is well known. Okay, by the treaty negotiators at Treasury. Because I wrote a post this morning that I sent over to you. We don't need to look at it. I'll just give you the summary. This problem is addressed to some extent, to a limited extent, in the Canada-U.S. Tax Treaty, Article 30, Paragraph 7. What it basically says is that if one country swoops in and taxes fake income, the taxpayer has the right to assume that the tax is owing in the other country at the same time, right? To at least avoid the double taxation problem or mitigate it. We have that in the U.S.-Canada Tax Treaty. Interestingly, for all the complaining about the Australian Tax Treaty, there's a 2001 protocol that has that. And the 2016 U.S. Model Tax Treaty addresses that to some degree in the context of moving around immigration, but that's not even really what we're talking about here. So this is the problem. Now, to go back to your question about specific examples, I can't remember what I put in the post, but I can come up with a couple that probably were in the post. One would be renunciation of citizenship, right?
Okay.
There's a deemed sale of assets for covered expatriates.
So and again, and there is that, and I just want to go back to this because it just sort of let me go back to this, just sort of my definition here. Again, when they say deem, what do they mean? There's like, well, it's just our opinion you had income. It's just our opinion you had income. That's all it is. We think you had income. Okay, well, why? Well, because we think you had income. And so there's really no, when they say that word deem, to me, that sounds just like a conclusory statement, a tautology. Well, what's income? Well, it's whatever we deem, whatever we think is. We don't need to go any further than that in our analysis. We can just say it's our opinion. And so I think it's one of the most dangerous words that we have. And I've been hearing, and I've always heard that, in tax, you always hear it. Oh, we deem. Got a lot of opinions, don't you guys? Can you give me any reasons why? This is actually income. But back to the expatriation tax. Now, how does it work precisely here, John? We're
listening to you there. You gave me a really, really interesting thought that I want to get into this just so I don't forget it. Basically, maybe somebody can write this down. But the issue in the Moore case, right, is whether the 16th Amendment requires realization of income, right? Now, my view of this, in my view, makes no difference, of course, in the world. However, my view of this is that because the 16th Amendment creates the right of the federal government to tax income, that income must mean something, okay? I mean, it can't just mean anything. Now, if we look at the language of 877A, it's funny. I thank you for your analysis there, because that's what caused me to think of this. But you'll notice that it says all property of a covered expatriate shall be treated as sold.
There you go. Right.
Treated as sold. It's as though they know it's not income.
Right.
Right. So they know it's not income. They know it's not income, and they make it clear through the language, treated as sold. Okay, they know that to sell it, gives the realization of it. Now let's just pause for a second here, right? And go back to the 16th Amendment requirement of income. And the issue in the Moore case is, of course, whether realization is required. And then we look at something like this. I mean, it's very clear in its expressed terms that there was no realization of income at all. They're making it up. It's Congress once again. Let there be income.
Right. Well, right.
And
I would say here, you just made me think of this example too. For everyone who owns a house in the United States, okay, you guys are letting this slide. People just like, whatever, that's foreign income, who cares, whatever. That's what you get for being overseas and having income overseas, right? Well, let's just think, if they're deeming income for things that you didn't sell but as sold, well, why couldn't they just pass a law to say, you know what, we're gonna treat at the end of this year, we're gonna deem it as if everyone sold their house, and so whatever. Hey, look, if the capital gains exclusion applies, okay, you're all right. If not, if you have a house worth a little bit more, we're just gonna say you sold it. You just because it's always our opinion, and we're free to do that because we've been doing that for 100 years.
This is the war on wealth tax. Okay, this is the way.
Well, yes, and on this, but actually, I think on more. I actually was thinking about that a little bit more last night, and I think it's actually more frightening. Because really, you don't even have the wealth. As a shareholder, that's not even your wealth. You would have to force some sort of lawsuit in order to split up the corporation in order to claim whatever portion of yours is that's really not yours. That all of that equity is the corporation's of which you have a share, but it's really not even yours. And so that's one of the biggest problems that I see with it.
Well, that's a big problem with the Moore decision. And of course, the Subpart F regime, really was designed to get around, the understanding that the U.S. could not directly tax foreign corporations on non-U.S. source income, which is actually expressed in most treaties, by the way. In Article 10 of most treaties makes that clear. Yep. So you see, the Subpart F rules were really designed to find a backdoor way to tax foreign source income of corporations by using the U.S. shareholder as the conduit, right? By attributing it to them. But what they've done in the transition tax is something that what they're attempting to do, I think, is some kind of nonsense sleight of hand. There are some of the judges in the I think particularly the Ninth Circuit said that the transition tax income was not a new kind of tax because it was under the Subpart F regime, which is completely idiotic. Because you can put it anywhere you want in the Internal Revenue Code. And what do they think, by adding it to Subpart F income somehow it ceases to not be a new tax, etc. But
well, they deemed it. They deemed it. That's what they did. They deemed it.
Right. Well, what
problem solved. We deemed it.
It's very simple. Let there be income.
There we go. We deemed it. Right. There we deemed income. Well, I want to just get we got some great comments already here. So here's a comment from Mike Breen. He's still amazed other nations are still allowing this to happen without so much of a squeak as complaint.
Well,
common,
Mike, Mike, here's what I was thinking about this morning in this new post that I wrote. My view of this is that other countries really need to be submitting amicus briefs in the Moore case. I'm serious, to say, look, if this court rules that the U.S. can go, let there be income, and poof, there was income, that's going to expand this nonsense into our countries as well, right? And this is, what I'm obviously, because I'm where I sit in the world, I'm much more concerned about this as a problem. if you expand, so you start off with, you expand the definition of income in the United States to fake income. And then through the citizenship tax regime, you export that definition of income into other countries, creating a situation where there's a taxable U.S. event prior to the taxable event in the source country. Not only are you creating double taxation in most countries under most circumstances, but you are literally attacking the tax base of that country and siphoning productive capital out of that country to the United States through the tax system. We see how that works time and time again with transition tax, GILTI, Subpart F, I think to a lesser degree. The PFIC rules operate in exactly the same way, because remember that the way the tax is calculated is the assumption of a distribution of income in years where there may have been no income. Okay, so I mean, it's a little harder to see there, right? But there's no doubt that's exactly the same thing. And these are examples, right, where it's not, you can't say, well, this is just the US tax and something the other country doesn't. No, I haven't even gotten into that. I'm talking about situations where both countries tax the income, but the US kind of swoops in, siphons out some of that capital, thank you very much, and brings it back to the homeland, right?
Yeah, and I think that Suzanne's hitting the nail on the head here. She says most countries tend to put their hands in the sand when the U.S. is concerned. It really, I think they're intimidated and they don't want to really mess with the U.S.
Or do you also,
well.
Excuse me, Anthony, but do you also think that the countries just don't understand what's happening with this? They just don't understand.
That could be very true, and that could be the could be the bigger truth, right?
Because the U.S. tax code is so complicated and so convoluted.
Yeah, well, and they have enough things going on in their own country to deal with, and now to become an expert on U.S. tax is, well, it takes a little bit. Yeah, I can see them just like, hey, look, we have other things to think about. And okay, when that becomes a very serious problem, then we'll address it. And now it's more of a nuisance that can erupt into a larger problem. And that's basically how our entire tax system started. And Suzanne has a comment here. When they were talking about the 16th Amendment, which now as I've looked into it, I used to be one who said, "Oh, there's people who denied the 16th Amendment were crazy." Now I believe they're completely true. I don't believe it was actually ratified, and I think we can figure out that it probably wasn't. And this has always been my point. If we look at, is the 16th Amendment even necessary at this point? Because a lot of the proponents of the transition tax, like, yeah, we don't need to really worry about income. This is about something else. Because if you think about it like this, that in the 1930s we saw a massive expansion of the Commerce Clause, and the Commerce Clause got so ridiculous that wheat grown in your own backyard for your own purposes moves in interstate commerce, right? So if the Supreme Court is making a Commerce Clause mean that so ridiculous, why can't they make the Commerce Clause say, well, if you're doing a business, we can take a share, because why not? It's commerce and we can regulate it. So what's the problem? So I think that's really where, and I think that's where we are, where the current interpretation of the Commerce Clause is. It's so broad, it's so expansive, it sort of makes the 16th Amendment not really necessary, which is, sort of the whole problem of our Supreme Courts. We've just given it all away. We've given all the power to the government. There's nothing, there's really nothing to hold them back from doing anything. And I think I would say this, that people who are in favor of the more transition tax, that they're like, well, what's the problem? We've been doing this crazy stuff forever, and they're kind of right. Like, why are we objecting to this? Because things have been deemed, and this has been going on forever, as we've watched. And by the way, when the 16th Amendment was proposed, oh yeah, it was going to be tiny little tax on the richest people only. And it was going to pay for a social goods that would give us utopia. And, since that time, that's what we've had, right? That's what we've had.
Anthony, nothing. Yeah. There are no cases anywhere that I think are analogous to what's going on here. 30 years of retroactively attributed income, right? From a corporation, a non-U.S. corporation to a U.S. So nothing even remotely close on that. But look, you can say, well, this has been going on for years, and I think there's a partial truth to that. But what has not been going on for years is any organized challenge to this, right? Which is what the Moore case represents, right? So it's sort of like, let's say you have, a neighbor who steals from your garden every day for 30 years, and you just sort of are aware of it, but don't talk to him about it. And then you say, well, look, sorry, you're not going to steal from my garden anymore. So, well, what do you mean? I've been stealing for 30 years, right? It's as though somehow I think the government thinks the fact of organized objection to this means that it's sort of legitimate. You have to remember that in the case of the transition tax, the corporations were bought off, right? To not object to this, with a reduction in the corporate tax rate from 35 to 21%. That was a deal. All right, that was made. And by the way, this nonsense about deferred income is absolutely 100% idiotic and a fabrication of the people who would justify this tax. As far as I can see, the notion of deferred income appears for the first time in Section 965. Which is the transition tax section. They were saying, well, this income was deferred until you bring it back. It's the tax was deferred until you bring it back. That doesn't mean that there's a guarantee it's coming back. That's just a simple statement that when a dividend is paid, it's taxable by the U.S. This is not deferred income. This is totally made up, fabricated income. For the purpose of trying to make the TCJA work is what it is.
Yeah, and here we go from Mike. We get some interest, polite interest, right? This is about sums it up, right? But seriously, who has the time? I mean, this is so well said. Who really has the time to learn about Subpart F, PFIX, all this stuff? You only learn it if you have to learn it. You don't want to learn. Who would want to learn it? So there you go, right? And it's just to downplay it, easier to go away. Okay, something will happen, and just hey, maybe the Supreme Court will save us, right?
Right. I have a
Keith,
question,
what do you have to
if
say?
I may.
Yeah, Keith.
Yeah,
Yep.
I was talking, even though this is probably not going to be applicable, the transition tax, if somebody sets up a CFC today. But the question I had the other day is from a gentleman who's in Japan, and he wants to set up some type of entity for himself. How does he find out? How do I ask the question? How does he ensure that whatever he sets up is not going to be deemed a CFC by the IRS? Where does he get that information, or how does he find out to ensure that it's not? Does that make sense?
Yes, it does. Yeah, no. There's actually a simple answer to that one. He can make an election to disregard the foreign entity.
Make an election to disregard the foreign entity.
Check the box.
Allows the election, Anthony. One of the problems with Canada is that the Canadian corporations, with one or two small exceptions, are deemed per se corporations. An election may not be possible.
So what do you do to ensure that you definitely don't set up inadvertently something that's going to be recognized as a CFC?
You don't ask the question online. You pay money to work with somebody who understands. It's the answer.
Okay.
Yeah, and I would say that
what I hear from you is that there's no way to search for something in the tax treaty or on the IRS website. They really need to go to somebody who has an expertise.
I will say this. One of the fascinating things about the corporation thing, and I've mentioned this before on this podcast, but I'll say it again, this is absolutely fascinating. Although the Internal Revenue Code talks about how corporations are taxed, they don't talk about what a corporation is. That's completely delegated to Treasury. The Treasury regulation, you can find it in 7701. Go ahead, have a look.
Just to reiterate, because John's right. So we have a corporate tax, we have a corporate income tax, and our tax doesn't define corporation. We have an individual income tax, and the tax does not define what an individual is. These are all things that are these are off. Just say, hey, regulations, take care of that, because we don't want to bother with it, because that's a tough. It's really hard to figure out what that definition is. So we'd rather just the regulations. Someone else do the regulations, and then we'll deem whatever we need to deem, and everything will be fine. John, I want to move on and talk about some of the other other taxes that we're talking about. Guilty tell me about guilty and how that is taxing income that is not. Oh wait. Oh wait. I see deemed. Oh, I see the word. I know where to go. Whoa, net deemed tangible income return. Wow, that's a whole bunch of word salad there. Well, that can't be frightening whatsoever. Net deemed tangible income return. Wow. You want to get into this?
Well, I mean, okay. So let's just back up for 30 seconds, okay? And then the answer to that will be clear. So the whole issue is how the United States can directly tax the income, the foreign source income of foreign corporations, how they can do this. The way they do it is through the U.S. shareholder, what's called a United States shareholder, okay? So foreign corporations with sufficient ownership by United States shareholders, I'm not going to get into the details, right, are called controlled foreign corporations. And the whole purpose of this is to remember that a corporation is a separate legal entity and therefore is generally taxed separately. The whole purpose of this is, if you will, to pierce the corporate veil. And there are three kinds of income, right? So, when you look at what's happening in a corporation, you might look to the past, you might look to the present, okay? And when you look to the past and the present, you might look to different kinds of income, right? So what happened was, and this is all sort of what Subpart F is about. Now, at the risk of oversimplification, and this is oversimplification, the purpose of the Subpart F rules in 1962 was to find a way to tax passive income. Okay, investment income earned by foreign corporations, did not go after active business income. So then what happens, in 2017, when the U.S. multinationals are negotiating for a lower tax rate, part of the discussion is, well, look, we've never been able to tax all your active income, and you've never brought it home because we have a 35% tax rate. What moron would do that, right? Okay, and so what we want is find a way to get you to pay a tax on the past active business income that was never taxed before. So that was the transition tax, right? So the transition tax was going after the past active income. Subpart F continues to go after passive income, right? Investment income. But what guilty is, it established the principle that current active business income would be deemed to have been received by the shareholder as well. So what you have is a situation like this, and it operates differently in different countries because, of different tax rules in different countries. But what you have now is a situation where prior to 2018, active business income was not deemed, they didn't go after the active business income through the shareholders. After 2018, the purpose of the guilty is very, very specifically to tax the active non-U.S. income earned by foreign corporations. And that's whether it's actually distributed or not. Again, it doesn't matter whether it's distributed, right? It's same as Subpart F, same as transition tax. If the corporation earns it, the shareholder has to pay tax on it, whether it's distributed or not. Okay, are you with me on that?
I think that was a great, and I really like what you did. So Subpart F is for passive. It's a way to get after the passive income. Then guilty is a way to get after the active income. And now to just continue a little further, but what guilty does is it gives you a little break if your income is related to assets. Is that true? Would you say that part's true as well?
Well, it's one more ridiculous fiction. What they do is, I'm going to be really quick on this because I think it's so completely irrelevant to the principle. But basically what they do is they give you a 10% carve out, if you will, a 10% return on your fixed assets used in generating the income. I mean, that would have value for a large manufacturing company, perhaps, or something like that. But let's not kid ourselves. The people bearing the taxpayers bearing the brunt of these are individual taxpayers in other countries, and they don't have, contrary to Treasury's fantasy, or maybe outright lies. They don't have large corporations, etc. I mean, these are like, the barber shop, the yoga studio, the accounting person, the dry cleaner. Maybe the dry cleaner has some assets, but I think that to talk about excluding the 10% return is frankly irrelevant, and I think all it does is makes it harder to see what's going on. Very, very simply, what GILTI is the U.S. is going to tax the active business income earned by the foreign corporation to the shareholder in real time as it's earned. Okay.
Wow.
Now they tax it at a lower rate for now, but it's going up. But one of the things that I find incredibly offensive about this, I don't know how anybody can be so stupid as to believe that the U.S. somehow moved to a territorial system of taxation for corporations. I mean, sure, after they tax it for, then it's not going to be taxed again when it's distributed. But really, honestly, Anthony, if you think about this and make any effort to understand it, when the U.S. made the claim that, the TCJA was moving corporations to a territorial system of taxation, no. What they meant was that the U.S. was increasing the territory over which it was
oh God, you're hurting me. Oh God, this hurts.
I mean, let's be clear on what this is at least, instead of stop making up all this garbage, these fantasies.
Well, this is, so you said a phrase back there, and I just want to spend a few times with it because it's a phrase that we learn in law school: piercing the corporate veil. Piercing the corporate veil is something that you do when someone's not honoring their corporation. Say that you have a business with them and they're not doing the corporate formalities and they're just treating it as their private piggy bank. A creditor, someone can pierce their corporate veil and say, hey, look, we just actually want the assets. You're not entitled to the limited liability protections, and you're not even entitled to this organizational structure. We're going to pierce that corporate veil. Nevada being one of the states where it's most difficult to pierce the corporate veil. Well, what you just said was kind of breathtaking, because what the United States government is doing is they're not just piercing they're piercing the corporate veil in countries in which they have no claimed jurisdiction, and really like that corporation, the country's laws create the corporation, not the U.S. tax code.
That's right.
And the way this is they're just, well, we're gonna deem as if we pierce the corporate veil, which means you pierce the corporate veil. So, I mean, there's something very frightening about that. I mean, that is what's just utterly frightening. So where was this, and where, during the debate over the 16th Amendment, was this even on anyone's, hey, wait, this is a bad idea, because eventually this is going to be a basis by which to pierce the corporate veil and take whatever you want from a company. And I think this is what we have. I mean, this is really the true. We have the United States tax code piercing the corporate veil to create phony events that aren't even there. And I would say this: in some that the wealth might not even be there. You don't even have it. You're taxing. It's not even. You're not. That's where you're not really taxing the wealth, because the wealth isn't even there. You're not taxing the income because there wasn't income. So what is this? So what is this exactly?
Well, Anthony, what it is, it's the use of U.S. citizenship, using a U.S. citizen to extract capital from countries. Is what it is.
Pry that open, right? Yeah, there. I would say that's a great analogy. You, as a U.S. person,
and people think this is sort of nonsense or extremist, and they probably will. I say it again today. Other countries should not have U.S. I think that in Canada, I think that there ought to be a requirement of non-U.S. citizenship to be able to incorporate a Canadian-controlled private corporation. I really do, because
I would say that.
Let me tell you something. Let me tell you something else here. Okay, I've been thinking about this a lot recently. I'm going to stop very soon thinking about it, by the way. So this will probably be the last podcast where I remember anything about my thoughts. Okay. But one of the things that became evident to me a couple of weeks ago, it's so obvious. It's always been right under my nose. I don't know why I've never seen it before. But, so we go back to the Treasury regulations, right? So Treasury in 1996 deems all these Canadian-controlled private corporations to be per se corporations. That locked them into Subpart F guilty of the transition tax, right? That was the provision right there. But what's fascinating is the application is to Canadian-controlled private corporations. Now, the definition of, in order to qualify as a Canadian-controlled private corporation in Canada, basically, you can't have a majority ownership of people who are not Canadian tax residents. Now, what that means, okay, leaving aside the gobbledygook, is there's no possibility that a bunch of U.S. residents in Florida could get together to form a Canadian-controlled private corporation because they never could under Canadian law. So what we have is this incredible situation where not only is the U.S. confiscating assets of Canadian-controlled private corporations, but U.S. residents couldn't even use that structure to invest. You see what I'm saying here?
Oh, right. Oh, my.
I mean, you can't make this stuff up, Anthony. You can't make it. This is, look, and to be very clear, because of this, I mean, the people at Treasury will sit there with their cigars, and say, well, what if we had a bunch of U.S. investors who set up a Canadian-controlled private corporation to defer U.S. tax? Well, buddy, that assumes they can do it under Canadian law, and they can't. This is nothing but a pure confiscation of the assets of small business entities in other countries. And frankly, no reasonable argument can be made to the contrary.
No.
Gentlemen,
yeah,
I'd like to make a statement here and tell me what you think.
Yeah,
Based on everything that you both are saying, if you are an American overseas that has one of these entities that's deemed a CFC, and you're not in the U.S. tax system, there's no incentive to enter the U.S. tax system because it will ruin you. Is that a correct statement? Why would you enter? Because there are a lot of people out there who have these. I've talked to them, and there's no reason for them to enter. So, right?
Unless you have to.
Yeah, so that's the key question, Anthony. Unless you have to. What would be unless you have to?
Somebody's going to blow the whistle on you, or you're going to get a source, it's that you're going to get a source of income in the United States. Those are the situations,
right?
If you're going to get an inheritance from the United States, or you're going back, those are the situations where, also sometimes, sometimes, and this is often the reason why, but this is actually not applicable in this case. Oftentimes, a reason why a man, typically it's a man, who'll come and say, "Hey, Anthony, I need to fix up my tax problem. I'm getting married." Okay, but in this case, well, hold on. Hold on. Do you want to stay married? Maybe you don't. Maybe I should talk. Well, talk to Keith, because I don't want to say this is where Keith, you are absolutely. And I just want to get, let me get your contact information up right now, because you're really the person to talk to for something
and
like that.
You guys, I know you guys don't have the answer to this, but I'm going to ask the question anyway. Do these people that put this stuff together realize that that there is no incentive every time they put this into play for people to get right with God, get right with the IRS? In fact, it's the opposite that occurs.
They don't.
Do you think they realize
the
this?
They don't care because they have the penalties. Well, you're going to do it because we don't care.
Well, wait a minute. They have the penalties, but there's no penalties if you're not in the system.
Right, but they don't. But we'll eventually get you. We'll eventually get you. They're not thinking. I don't think they think of that. I really don't. No, why? Because they love their penalties too much. They're so in love with their penalties, they're not looking at the rest of the world. We love our penalties. This is what I would say. I was thinking of the analogy that you have. How U.S. persons are used. Right, we're abused. Used on the globe. So what U.S. persons really are, and this is sort of backing up what John said, is that U.S. persons are used as crowbars. They're used as crowbars to open up foreign assets so that the government can open that up and then grab some money and take it back. I mean, that's really what you are as a U.S. person. You are a crowbar.
Crowbar. The Trojan horse soldiers. Okay, you remember the Trojan horse?
Yeah.
Whatever it was, ancient Greece. They immigrate to other countries, and their very existence can be used to attack the economies of other countries, which they do.
In this analogy, the horse would be the American, but inside the horse is the IRS. That's basically what it is. Oh yeah, hey, look, we got someone who wants to invest in here. Oh, this is great. Yeah, come on in. We got the IRS inside.
I don't know. I think the the horse is some immigration policy in a country where they're trying to achieve. So, why are there so many Americans in Canada, or people who started out as Americans? Well, in my life, I've witnessed two, major events, right? The first was the draft resistors, who came to Canada in the late 60s, early 70s. There's a whole group of them. And the second would be the tremendous expansion of the Canadian university system. Most of the universities in Canada are public universities run by the government, whatever, and tens of thousands of American PhDs were hired to move to Canada, right? So the horse would be some kind of immigration policy. But remember, at that time, none of this was going on. Nothing even remotely close. This stuff really began to, gain ground. Some of the seeds were planted in the '86 tax reform. That was the introduction of the PFIC. A very large part of it was during the Clinton years in 1996. When these Treasury regulations, the foreign trust rules, etc. We have FATCA, of course, 2010. We have the offshore voluntary disclosure, initiated by the Obama administration. There's been a progression, right? So what happened was that these Americans who moved to countries, they may have been, not necessarily harmful to countries when they came, but now, as Americans, they're very harmful to the countries where they live. Very harmful, and they stand a much better chance of, because they can't invest properly, right? Of, being in need of public support as they age and stuff like that. I really.
Oh, hey, look, I
really
want to cover.
The next stage of this discussion is on the immigration issue and the cost to a country of having an American citizen living there.
It's bad. It's bad. Bad. I want to move on to another example of taxing non-income events, and this is the treatment of certain foreign currency transactions. Certain foreign currency transactions.
You mean is it certain one, or is it certain ones of a group as usual?
Yeah.
Whatever.
So this is really the So if you're using another currency and that currency does well, you have a gain, but you really don't have a gain. That's the thing. You really don't have a gain. Your money's the money. It's just like, well, that means that the U.S. dollar stunk. But because the U.S. dollar went down doesn't mean that my money became worth more. It's just my money that I'm using in my daily life. And that is a pretty obnoxious way to go about things. Well, we're intentionally devaluing our money through the private bankers known as the Federal Reserve, and therefore, because the currency that you're using isn't so devalued by the Federal Reserve, you've had a gain. Don't you see? So if you can convert that money into Federal Reserve dollars and now pay us, everything's going to be good because we're here for whatever the government's there for. I'm not sure at this point what they're really there for.
The most common example of this, right, for Americans abroad is the sale of a house or the discharge of a mortgage. In the United States, it is common, usual, and conscious, if you will, with respect to real estate, to see two transactions going on, right? The first is contract to buy or sell the house, and the second is the financing, which people would call the paper, right? Those are two independent transactions. So what you have, right, is a situation where, say you buy a house in Canada, whatever, or any other country, name your country, in Canadian dollars. You sell it for the same price in Canadian dollars. There may have been no gain in Canadian dollars, but because of exchange rates, maybe there was a capital gain, right? In US dollars, because the way it's calculated is, remember, the US citizens are on a US dollar leash. Okay, they're on a US dollar leash. They think everything about them is US dollars. In fact, I think that probably all other countries should have a separate, market system, if you will. You go into a store to buy groceries. I think probably they should have non-US, like going into a country, customs, non-US citizens this counter, US citizens this counter, right? So they can operate only in US dollars or something, right? But there can be a gain or a loss, and I see a lot of this, and of course the gain is taxable. Okay, if there's a capital gain, which, by the way, is another good reason for those of you Americans abroad who are thinking about how to file your taxes. A good reason why you don't use the foreign earned income exclusion, because if you can accumulate excess foreign tax credits on the passive basket, right, those can be carried forward to perhaps offset a loss on a capital gain. The other, though, is, and this is, I think, familiar to everybody, is that if the exchange rate changes in such a way that by discharging the mortgage when you sell the house, you're actually discharging fewer US dollars, than you might have, right? Then the difference would be income. And that's treated as ordinary income. And of course, if it's a loss because it's a personal property, you can't deduct it in any way. I mean, this is a real trap for people, a real trap.
Yeah. And I just think we have a comment for Susan. Countries want to be viewed positively by the U.S., which is true. And I think it improves their worldwide reputation to be on the good side of the U.S. So ignore or go along with all the wrongs. And that actually seems like a pretty well-stated comment. I can imagine that you don't want to be the one looked at like, who's this person in this country giving us a problem? We're good with you, U.S. And I think it just goes through, how much of what would I call us here? A little bit of bullies, I suppose. We just scare everybody. Hey, we're gonna destroy you if you object, right? You understand that.
Well, what do you think of the idea of all countries simply setting up a separate sort of, system of commerce for Americans that operates in U.S. dollars only? American, we operate in U.S. dollars, avoiding this whole problem. You buy a house.
There you go.
Mortgages has to be in U.S. dollars, right? It's interesting,
There we go. And I think, just put in the tax code and other countries will sign up on it. I mean, that's really what it is. Just whatever law you're looking to pass, put in the tax code, it always gets followed.
Yeah, and require all Americans. I've said before, the FATCA bank require all Americans, to operate only through that U.S. FATCA bank. I mean, I think a lot of these problems would go away if they were just understood better. And U.S. citizens,
I think so.
Restrictions. I'm a U.S. citizen. I have fewer freedoms than everybody else. That's all.
Yeah. That might be one solution. Well, we're bumping up on time here, so I kind of want to get some concluding remarks about what we think about more. What we hope to happen in more, and I would say this. I'll just start. This is what I'm hoping happens in more. Obviously, we get a positive decision, but really, what I'm hoping more triggers is an awakening by Americans to see, look, whatever happens overseas is just a trial balloon for what's going to happen here. We see that. We know that whatever thing they're going to do. So if the IRS is allowed to get away with what they're doing and more, we are now beyond the government will have a right to seize whatever it is you have or give you a bill you can't pay because you might not even have it. And that's the thing. You're going to be taxed on things you don't even have. So So just say, okay, just beware. If more gets ratified, then hey, look, the government can just send you a tax bill every year for whatever reason it wants, and you will be permanently bankrupt, and you will be permanently unable to move. You'll be a permanent indebted to the United States. I mean, we already are in a way that any dollar you make, the second you make it, the United States government has a claim on it. And it's just up to them how much they give back to you. That's how the law actually operates. It's sort of, amazingly obnoxious. So my hope for this is just that it opens some eyes and gets people who, a lot of people in the tax industry don't look at it as a bad thing. They don't look at it makes me money, right? So it's not that bad, right? But maybe this is a little too much because your stuff, you yourself, not just your clients, but you might lose all of your stuff. Now it might be a little different, right? It might feel a little different when it's you. Keith, what would you like to conclude with today?
You know my opinion. I've already said it.
I
mean, Jesus. I mean, if you got one of these entities and you're not in the tax system, stay the hell away. Stay away, because it's the people that are getting hurt by this are the ones that try to do the right thing, quote unquote. It's incredible. So you're getting taxed on income you don't even have. I mean, how ridiculous is that? So why would you put yourself in that type of situation if you don't have to? Obviously,
if you don't have to,
everybody's
right?
situation is different.
Right.
Everybody's situation is different. I always put that caveat there.
Right.
But
how trusty? You got well, you're looking to ruin me, right?
Right. So let me. Yeah. So I was going to say something vulgar, but I won't. But ruin me. Go ahead and ruin me.
John,
that's all I have.
Concluding thoughts. Thank you, Keith. Thank you so much.
Okay. The Moore case is the most important case decided in the history of the United States. Let me start with that. It is not so much about the transition tax, and it is not even about the issue of unrealized income. What this case really is about is whether there is any limitation whatsoever on what Congress can tax, anything. Okay, this is what the case is really about. Is there any limitation at all to Congress's tax authority in terms of, whether it's realized, whether they can attribute it, et cetera? And the more context is, just the excuse to get it there. Now, there are people who understandably say, well, the abortion rights case or the Second Amendment gun case, these have been the most important. Absolutely false. And here's why. In the modern world, and this has been true for some time, the fundamental organizing principle of society that creates opportunity, denies opportunity, facilitates retirement planning, etc., is a country's tax code. And I've said many times, and this is recognized in the United States. I mean, I think it's gotten to the point where the Internal Revenue Code probably is the Constitution of the United States. But the bottom line is this, that because of what the case really means, that is there any limitation whatsoever on what Congress can call income? What this case is really about, and it may sound like an exaggeration, but I'm serious. I do not believe it is an exaggeration at all. Whether there's at all of any freedom for Americans going forward, any possibility at all. Because if you give Congress the right to call anything income, you've given them the right to regulate through the tax code literally every aspect of everybody's life 24/7. So, and as important as things like abortion rights may be, or Second Amendment, or any of these other, affirmative action, any of these other things, they pale in comparison to the issue that is currently in front of the court. So, I don't know what they're going to do. I am, for those who complain about a so-called conservative court, well, you may think you're lucky stars that the composition of the court is as it is, because you can be sure that if you had 5 sort of liberal appointees or more on the court, they would basically sign away the freedom of Americans. They'd lock them up through this decision, and they would throw away the key permanently. Now, I'm not saying that if the Supreme Court rules that there are limitations on what Congress can call income, that that guarantees that Americans can look forward to a free society. I mean, that depends. There's a tension between freedom and democracy, as President Kennedy so eloquently enunciated in his inaugural address in 1961. There's always that tension, but I guarantee you, given the importance of the tax code, that if a decision comes down that says, in effect, there is no limitation on Congress's tax authority, it's all over. And so I think that individuals ought to put aside their partisan differences here, and I think that they ought to, make a lot of noise about this, because if the court rules that there's no limitation on Congress's capacity to regulate people's lives through the tax code, I assure you, things like gun rights, affirmative action,
doesn't matter. None of it matters.
So that's what I think. Aren't you glad you asked?
That was beautiful. I think I'm going to try to pull that one out for the promo. That was a beautiful.
Yeah, that was very good.
Very well said. Thank you, John. Thank you. And I really, really appreciate everything and all your hard work doing the research for today. Thank you very much, John and Keith. And I would just want to tell people, be sure to subscribe and turn on the notifications. That way you're aware when we're going live, and then you won't miss stuff like this, which is just utterly incredible. I really want to thank Keith and John so much for their continued, giving me continued education of what's going on and give me a brand new, a larger, much larger perspective than I had just as a little tax attorney by myself. So I want to thank both of you. I want to thank all our viewers and for your comments. Thank you so much. And we're going to keep updated on this, and looking forward to see comments. Please leave them below. This is Anthony Parent of IRS Medic, and I thank you for watching.